the CEO of RedCrest Investment Management. I'm also part of the Broker One family. Ron De Silva has taken over that role of CEO of Broker One. Broker One is a national mortgage brokerage operation, and there are many brokerages underneath it, of which RMA is one of them. As David mentioned, I've been in the industry since 1981. Always on the mortgage brokerage side. Started with trust companies. Good morning, welcome, come on in. Started on always in the mortgage brokerage business and the trust companies, and for some of you that might remember those days, those were the days when interest rates were 19, 20, 21%. And when I started my career, really the only kind of home financing we did was vendor take-back mortgages, which is a term that's not widely used today. And we were basically selling paper. People, because of the high rates, were when they were selling their house, they were taking back financing. That's why it was called a vendor take-back mortgage. But they obviously couldn't hold the paper because they were buying somewhere else. So at the time when I was with Guarantee Trust, we would buy that paper, and obviously we would buy it at a different yield, and that's how we would make our money. And mortgage brokers made a lot of money back in those days in regards to vendor take-back financing. So I'm currently with RedCrest Investment Management, and RedCrest Investment Management is a private mortgage investment corporation, a limited partnership, and as well as a servicer. We service the mortgages that we take in as well. Next slide, we don't need the confidentiality. So we're a non-bank mortgage lender. We service diversified portfolio of mortgages for investors, and we offer our investors a simple and convenient form of lending and providing them with stable and attractive returns. So people invest in RedCrest Mortgage Investment Management, and we give them a return on that money, and our return is all done through real estate financing. We started in 2014, so our return to our investors every year has been over 9%. So just to give you a little bit of the landscape of the mortgage lending market, you've got your prime lenders, which are your banks, your alternative lenders, which are like the home trusts or the equitable banks that you may know. They're regulated. Our industry the private lenders are unregulated, and in the regulated space, banks, monolines, trust companies, they're federally regulated financial institutions that are regulated by OSFI, which is the Superintendent of Financial Institutions. As you know, you've probably heard on the radio over the last several years, there have been lots of changes to mortgages and what these federal regulated financial institutions are allowed to do. You may have heard the term B20. That's the new guidelines and legislation and regulation of which these institutions have to follow, which unfortunately have meant that a lot of good borrowing, solid consumers have had to go to the private markets to get their financing. So there has been quite a big increase of private lenders, mortgage investment corporations that are sort of lending those dollars to very well qualified consumers, which unfortunately they can't do with the financial institutions. Just a little bit in regards to the market size. Benjamin Tal is a CIBC economist who does a lot of speaking in the mortgage brokerage industry. And new mortgage originations in Canada amounted to just over $405 billion. This is a 2016 quote, so it's well over $400 billion today. Private lending in Ontario currently accounts for a record high of 10%. So that's quite significant if you think about it. 10% of all mortgage customers are going into the private lending space. And obviously their rates are a little bit higher than they would get with their financial institution if they had qualified at the time with a federally regulated financial institution. So after having said that, I mean, obviously the future is bright for private lenders, and they are filling in a niche right now for those borrowers. So the impact on the housing market is obviously going to depend on the extent to which these borrowers will migrate to the non-federally regulated mortgage institutions such as RedCrest or private lenders. And we talked about OSFI and the rule changes and the B20. And basically that is the stress test. So even though the bank is offering rates at lower than the test that OSFI has implemented, you might be getting, or one of your customers might be getting a mortgage at 4.5%, let's say, but they need to qualify at a rate of 5.9%, which is a rate that the regulator has imposed as far as qualification. Then there's also the reasonability in regards to these financial institutions in the past. If they had good equity, good credit, they were self-employed but didn't really show income, they were able to do that. Today, based on the new regulations, they're not able to provide that. There's a reasonability test and, of course, the stress test they put on that. Thanks. Talked about OSFI, the Canadian Banking Regulator. So the creation of these guidelines basically has been, and a big part of that, which I've got here, the creation of that the regulator, the Bank of Canada, put in these rules is 2008. There was a big meltdown, obviously, which we all experienced, and in regards to that, there was a fear that the consumer was over leveraging themselves, and that's why they put these regulations in. Plus there was great appreciation of real estate, which we've all experienced. They felt that was getting a little bit out of control, and that was sparked by the amount of borrowing that continued to go. So they wanted to sort of put an ease to that, and part of their reasoning to put in a lot of these guidelines. So the creation of these guidelines is a direct result of what we've been seeing, and the underwriting guidelines have been created on the insistence of the Financial Stability Board. And I've already, in regards to government regulators, what their concern was. Again, overinflated property values, rising delinquencies from over-leveraged borrowers, although that's not really true. We haven't really experienced high degrees of delinquency, and we talk about that later on in the slides. Next slide. So, which all really kind of boils down to that market share for private mortgages is increasing. So a recent study in September of 2018 by Teranet and Realosophy of refinances, this is during the second quarter of 2018, in the private channel jumped 67%. Now it's just in that quarter. You saw in the earlier slide I said that private mortgages are as much as 10% back in 2017. I believe it's a lot higher than that. It's probably closer to 15%. But this is just a jump in one quarter of the regular mortgage consumer looking for financing, couldn't find it with their financial institution, whether that be banks, and so have had to go into the higher space. So obviously our industry, Mortgage Investment Corporation, private lenders, is increasing substantially, and what we're seeing is higher quality mortgage demand is being pushed down the chain to the private lenders, and primarily driven by OSFI, as we've suggested. And the result is more stringent qualifying criteria and good borrowers, good payers coming into the private space, having to pay a little bit more interest for their mortgage. Next slide. So at RedCrest, we focus, we're a private mortgage MIC and LP. We lend to the consumer. Our concentration is basically in the GTA. So we say to our investors who want to invest in our Redcrest Mortgage Investment Corporation that we manage their money, we manage their returns, we give the hurdle rates that we give them, and we tell them that our focus is basically in the GTA. We believe that the Greater Toronto Area market is strong, will remain strong, and these are sort of the reasons why we see why there's really no risk in the Toronto real estate market. There's a significant worsening and lack of land supply. Land prices in the GTA have risen strongly, and we believe will continue to be strong because of the lack of land. Next slide. Immigration. 250,000 new immigrants. That's being increased by the federal government to 300, on its way up to 450,000 new immigrants coming into Canada. The majority of these immigrants are going to come to Toronto or Vancouver, and they're obviously eventually going to be looking for housing. And again, the housing demand and supply, we believe, will continue to be stable in Toronto and in Ontario. This is according, again, to Benjamin Tell, who's with CIBC, chief economist there. Again, other reasons: non-permanent residents who are comprised of mostly students and foreign workers has risen significantly, and again, they're going to migrate to Toronto, Ontario, BC, Vancouver. Again, other reasons why we believe that your investment will continue to be strong and that the stability of these markets is going to ensure lower delinquency throughout the mortgage. Next slide. Pent-up demand. The share of young adults, you hear every day that young adults, it's difficult for them to get into the market because of the prices. But they will eventually come into the market, and they will eventually be buyers, which again is just another note in regards to our belief of the strength and stability of the market, particularly in the Greater Toronto Area and Southwestern Ontario, really basically, in regards to that. It's an army of potential new buyers that are going to come into the market. So the stable long-term property values in the GTA, the impact of the regulatory changes obviously have been noticeable, short-lived mainly in the GTA and Vancouver, where the supply issues continue to be strong, and at this point we don't see any real relief, and these buyers are continually going to be good buyers, good borrowers, strong, but are going to be pushed down to the private markets. And this is just a compilation of really all the compelling reasons why we believe the market will continue to be strong, again, particularly in the GTA. Delinquency rates we talked about earlier. This is an old slide from 2016, and you can see the delinquency rates are really stable. There's very low delinquency, and in 2017 and 2018, although I don't have it on the slide here, there hasn't been much change. It's pretty much been, delinquency is not an issue as we see it currently, and the banks have all noted that with their results, that delinquency is not rising to any alarming or significant purpose. CMHC outlook, Canada Mortgage and Housing Corporation, these are their views on 2019. The the forecast is for a balanced market in the GTA through 2020. Sales are going to come down slightly, which you've seen in the reports, but we'll see house price growth be more or less in line with inflation. So not what we used to see, which is part of what the government was having an issue with 10, 15% increases in housing prices. They see it more normalized at the rate of inflation. So The high price growth in the downtown cores of some of the major GTA areas like Toronto, Markham, Mississauga, where there have been higher concentrations of condominiums, but in general, we're going to have a stable market, according to Canada Mortgage and Housing Corporation. For RedCrest, the three pillars of our business are origination, underwriting, servicing, and administration. So we take investment dollars in, we put them out at hurdle rates. Obviously, they will be higher than what the banks offer. Our strength is origination throughout our network of Broker One, where we've got 750, 800 agents across Canada. The majority of them are concentrated in southwestern Ontario. That's where our origination will come from. Underwriting, we've got a strong underwriting team. Our members at RedCrest have all very senior people that have always worked in the mortgage industry and certainly know how to underwrite a mortgage. And we service and administer our mortgages as well, which allows us to, if there are any trends, if there are any issues with clients, we can deal with them immediately and remedy any of those delinquencies. And again, even for us in the private space, delinquencies are very minimal. So the private lending landscape, while we say it's a fragmented industry segment with a large amount of private lenders relative to the few number of regulated lenders, as we talked about, the big banks mostly, private lenders require strong origination pipelines, which fortunately RedCrest has as being part of the Broker One family, and where private lenders are differentiated by the funding region, the loan size, and the property type. So while mortgage investment corporations and private lenders have been popping up, for a lack of a better term, across Canada, each one is really focused, and this is a good thing. They focus their lending on the areas that they know, what they recognize. They know what the patterns are in the regions and the cities that they're in. They know how to lend. They're comfortable with it, which is all great, I think, which speaks to the strength of the private lending community. So we believe, as far as RedCrest goes, mortgage investment, our advantage is our network of 800 agents. Oriental Financial, which is one of our partners at RedCrest, belongs to a large brokerage of 75 plus agents. The bank networks, again, with my career, I've got lots of connections within the banks that where we could get clients who require financing, perhaps couldn't get it from there. Lawyers and accountants, investment advisors, realtors, builders, a large network that we built based on the tenure. Mine I've already spoken about, which is 30 plus years, and most of my partners, between us, there's over 80 years of experience. Strong broker origination, which I've talked about. We believe the strongest Canadian market is in the GTA. That's why we want to focus on it. Enhanced liquidity, loan sizes. Our loan sizes are anywhere from $50,000 to $1.5 million, which is where we're comfortable. Our property types, we focus basically on residential single-family dwellings, which includes condos. And we do some multifamily housing and student housing on a case-by-case basis. The 5 C's of credit, as I say, when we look at a loan, as I talked about earlier, the financial institutions are really restricted by the regulated from OSFI in regards to the reasonability, the stress test. We go back, I mean, I started my career on common sense lending, which is really not what is practiced anymore from the financial institutions, because they can't. They're handcuffed in that matter. So, I mean, we review the credit, the character, the capacity, the capital, the collateral, the conditions of the property, and the underlying security is really what we focus on the most in regards to if something should happen, could we get our investment back for our investors? And how do we do this? We rely on independent third parties, site visits. We go out to visit all the properties that we lend on. That's important to us as well, so that we keep our investors and our investments safe. So we are regulated by FSCO, which is the Financial Services Commission of Ontario. We are also an administrator with FSCO. Our capability to administer all our mortgages in-house allows us to react immediately. We have an industry-leading loan servicing software that allows us to administer all the loans that we take in. And we manage default through risk and through consistent communication and immediacy to any issues that may arise, so that we can correct them with the borrower as soon as possible. We talked about this is our management team at Redcrest, and basically the purpose of this is just to show how many years, again, it's over 80 years in the industry. So I hope I've been able to give you a little more knowledge on Redcrest, a little more knowledge on the private mortgage industry, and just in regards to the career that we've had and why private lenders seem to be growing market share within the industry. I'd like to thank you all for coming, and I would love to take any of your questions that you may have. Yes?
This B20 is actually been great for private lenders, but do you see a pushback from the banks?
There is a pushback beginning to swell from the banks, from the real estate industry, just in regards to the fairness of the B20. Has it gone a little bit too far? As I talked about the stress test, where there's that gap between what you're borrowing at and what the government says you need to qualify at. Originally, the reason why that was put in place was because of the low interest rates. So they wanted to make sure that people were borrowing because money was free, not free, but it was very, very low. So the government imposed a qualifying rate. Now that interest rates have gone up over the last couple of years, and that seems to be tempered now. I don't think rates are going to go much higher, which many of the bank's economists have said that as well. They don't believe that qualifying rate is necessary. Somebody borrows a 5-year mortgage at 4.8%, they should qualify at 4.8%, not at 6%, as an example. And of course, somebody who has to qualify at a higher rate obviously can borrow less when it comes to the qualification. So yes, there has been a lot of pushback or concern from banks, from real estate, in regards to perhaps maybe the superintendent should review the rules that were put in place, and maybe alleviate some of them, or get rid of at least the qualifying rate that a lot of people don't feel is necessary today, because rates have gone up. People aren't borrowing the way they used to borrow. So there was a cause and effect. I think that's occurred, and perhaps maybe they can change the rules a little bit.
Do you think it can happen? I mean, the big banks, they make big profits, so...
Who makes big profits?
The banks. How does it affect their bottom line? It must
It doesn't affect them in any way. They are not. It's not the banks who are doing this. This is the government who decided
I'm talking
to.
about money.
Yes. So the way it affects the banks is that they got less people qualifying to borrow. So these mortgages that are going into the private space or being brought down the chain, they're not lending on those loans. We are. So have the mortgage investment corporations and private lenders benefited? Yes, because they benefited that good borrowing clients are coming to the private lenders for money. The argument is that the banks and the real estate corporations have said to the superintendent is that it's not fair that these consumers have to pay more for borrowing on a mortgage because of these rules, and perhaps maybe the cause and effect has occurred, and maybe we should back off it. Is the government going to make those changes? I don't know. It's hard to say, but they certainly have pressure on them from big lobbyists like the banks.
If no one else has something to say on that, I'd like to speak on that.
Yes, sir.
Last week, the Toronto Real Estate Board had their annual to-do. And they just, sir, last Thursday, I think it was, the Toronto Real Estate Board had their annual forecast and review. And for one day, there was a big noise in the paper of the real estate industry saying B20 was a bad thing. I'm going to say that the B20 was a good thing because instead of raising interest rates on all sectors to try and quell a real estate boom in isolated big city markets, they instituted this underwriting change, which affected the same thing, knocked the specs out of the market, and didn't raise interest rates on any other segment of the market. It also developed this huge channel of Alt A, Alt B, Alt C, private lenders that had been overwhelmed by everybody just went, well, you know, there's a great deal of excesses in street capital and this, that, and the other thing. People who are not quite deposit-taking institutions. And the mortgage brokers that were feeding them, breaking the rules. And I'm going to say, nobody is talking at all about CMHC portfolio insurance. Maybe this isn't the forum for that. But I do think they will back off it. And the biggest thing will be is buyers are not being protected from potentially increased rates anymore. They're not increasing rates. There's no threat of interest rates going up 2%.
Rates have gone up moderately in the last couple of years.
That threat's gone.
And that threat is gone. So no, I agree with you. And TREB is one of the. TREB is a huge organization, huge lobbyist that is also putting the pressure as well as all other real estate associations.
But that's self-interest. From a straightly facts standpoint, it's good.
Partly self-interest, of course, but also you, as we've been discussing here, you could make the argument, which is trying to be made to the regulator, that the threat is no longer there, as you've said. So perhaps maybe the qualifying rate, the stress test, perhaps maybe some of those can be softened a little bit. Yeah.
I think we need to, like, I'm not saying me or you, I'm saying we as a country have to adapt to what's today, because what I see is there's so many rules that were good 20 years ago, 5 years ago, and you have to adapt to what it's today. You cannot be living in the past all the time with the fear. And I think there is lots of fear in the market that's created. I think the government introduced way too many rules in a very short period of time, and it killed the market. That's, you know.
It slowed down the market for sure, significantly. And you know, as I said earlier in the slides, a lot of this fear came from the meltdown that was experienced in the United States in 2008. We certainly felt it here, nowhere close to the extent of what the United States in falling falling housing prices. So, I mean, I think our government has done a great job in managing that, but we continue to see 5 to 10% real estate increases, and perhaps it was a bubble, perhaps it was getting out of control. And as I said earlier, I repeat myself, there was a cause and effect, and I think it worked.
Yeah, they were too late, and now they're lagging. Again, same old thing.
I have a few questions.
At least it did something, otherwise it would have been a catastrophe.
Yeah, just 2 years late, that's all.
Okay,
Please go ahead.
Okay. As far as the investors, so I have a few questions on both sides.
Sure.
I have some clients who might want to invest into private mortgages. What is the minimum investment?
The minimum investment in our limited partnership is $100,000, and we offer a hurdle rate of that of 7%.
That's 7%?
Correct. And that's a hurdle rate. What I mean by hurdle rate is that's what we guarantee you, but at the end of the year, if we do higher, as I said, our portfolios have been doing over 9%, we share 75% of that back to the investor.
So it will be 9% or will it be less than? If you share the, if you
So-
make 9%,
Right, so the difference between the 7 and the 9, we take 25%
Oh, I see.
and give the 3/4 of it back to the investor.
8.5, something.
Yeah, back to
Okay.
the investor.
and what if the investor invests more, like 500 or $1 million? Is there a better rate or is it still the same?
No, it would be the same, but investors in our limited partnership, the rules are that they have to meet a minimum investment. They have to be what they call sophisticated investors, and there's a criteria in regards to what the sophisticated investors what they have to meet in order to invest in a private corporation. If they're going into the MIC, the Mortgage Investment Corporation, those are registered funds that we could take in. Olympia Trust is our trustee for that, and we have what we call exempt market dealers that will meet with your clients, talk to them about the investments, what the risk of the investments are, and Redcrest also qualifies for registered funds. And many people with RRSPs, and any amount of that, $30,000, $40,000 investments can come in. And many people are trying to increase their RRSP portfolios, which is what we're seeing.
Is there any return on investment?
I'm sorry?
Is there any return on investment? Or is it just interest only?
It's the interest that we
Distribution.
offer, correct.
Okay.
So I'm not sure, that is the return on investment.
Return on
No,
capital.
yeah, that's what I meant, sorry. Is there any return on capital at all?
In regards to, can you reinvest your capital?
No, return on capital.
Return of capital.
When do you get your capital back?
Oh, of course, yes, you're making a minimum commitment of 3 years, and after 3 years, you can get your capital back. If somebody wants it earlier, certainly, and that has happened, we accommodate it. But what the investor needs to understand, and what basically we go through all that criteria with them, as well as the exempt market dealer will, that we've got these mortgages currently in term. So if somebody needs their money back, we will certainly work with them, but we have to have a mortgage paid out in order to give that capital back. Because obviously, if we're paying you a 7% return, we need to have that capital deployed in order to give you that return. So if you need to get out early, again, as I said, it has happened. It doesn't happen often, but certainly we work with them to get them their capital back.
Okay, let's let Mohammed have a question, and
It's
we'll
okay,
take
I'll
another
wait.
one.
I'm
Yeah,
just
go.
showing that I-
No, appreciate it, good.
Yeah, my question is, how do you secure this investment?
Real estate.
And directly, or they have to deposit it and then you secure it later?
It comes into the Redcrest fund, and then we deploy it on basis of deals that we see that we originate through our
So
network.
it goes to a trust account, yeah?
Absolutely, yeah. Yeah.
Okay.
So, as I said, we've got our origination channel, so many people say, I've got this mortgage on this property. We focus specifically on residential, which is what our prospectus will say, and we focus primarily in the GTA. Where we feel real estate values, again, as we talked about in the presentation.
Elena, was there any questions back here, if I have my back, before we go back to Elena again? Gain, did you have a question?
Yes, I did.
Yeah, go ahead.
Okay. My question was, if you're investing $100,000, is there a percentage or amount that's taken for fees, for marketing, for anything, paying the agents? How is that all work?
We take a 1.5% management fee for the management of the fund, but that's basically it.
Oh.
Is that of the 7%?
Of the 9 that we're continuing to generate.
I'm lost a little bit. I'm lost a little bit.
Off the yield, correct. Yeah.
Elena?
Can you verify this? It's let's just base it on 7%, forget the increase in case you do better.
Correct.
So of 7%, you take 1.5%?
1.5% of what we make.
Of the principal amount.
None of the
Right.
7%.
Correct?
None of the 7%.
Not of the 7, no. Of what we earn.
That's what
Right. If we only earn 7%, we don't take a fee.
So the first 7% goes to the investor.
Correct. And then whatever's made over and above that, we take 1.5 of what is made, and then anything left over, we give back to the investor.
That's a bargain, that's a great deal.
And we have been, again, our track record has been over 9%, 9.1, 9.2.
Net, net.
Correct.
Oh.
And we have to, also as a mortgage investment corporation, we have to have audited financial statements on an annual basis.
I'm glad you asked
Are you
that
dealing
question.
with third mortgages also?
No.